Hey everyone, welcome back. We're diving headfirst into some serious charting techniques today. If you're prepping for that technical analysis exam, the one that can make or break your career, then listen closely because this is for you.
You got it. We're breaking down some really powerful stuff from our sources. This is the kind of knowledge that can take your chart reading skills to a whole new level.
Absolutely. We're talking about two big concepts. First, using multiple data sets and, just as important, multiple data intervals on those charts.
Right, because it's not enough to just see what's happening right now.
Mhm.
You need that broader perspective, the context, to understand where the market's been and where it might be headed.
Exactly. Then we're tackling something called market profile. Honestly, it's a bit of a hidden gem that can reveal a lot about the underlying forces, the supply and demand dynamics that are really driving those price movements.
And understanding these two areas, well, you'll start to see trends forming, how different securities relate to each other. You'll see the whole market in a completely different light.
It's like having X-ray vision for the market, seeing through the noise and really understanding what those lines on the chart are telling you. Our mission, and we're sticking to it, is to give you a rock-solid grasp of these techniques, all ready for that exam.
We'll break down the key ideas, show you how they work in the real world, and make sure you walk away with actionable knowledge.
So buckle up, folks. Let's get this deep dive rolling. First up, we're tackling charting multiple data sets and data intervals. Sounds pretty basic, right? Just looking at charts with, well, multiple things on them.
Yeah, it might seem simple at first glance, but this is all about seeing the market from different perspectives, both over time, using those different data intervals, and by comparing different securities on the same chart.
Okay, so let's dig into working with multiple data intervals. We talked about seeing the long-term trends and the recent price movements, but why is it so crucial to use this kind of layered approach?
Think of it this way. The market's noisy. It's full of short-term fluctuations that can distract you from the bigger picture. By looking at longer time frames, like monthly or weekly charts, you can filter out that noise and identify those major underlying trends.
So you're getting rid of all the little wiggles and focusing on the overall direction, but then you also need to zoom in, right?
Absolutely. Once you've got a sense of the long-term trend, you shift to those shorter intervals, like daily or even intraday charts. This helps you fine-tune your analysis, see those recent price swings, and pinpoint potential entry and exit points.
It's like using a map, I guess. You start with that regional view to understand the lay of the land and then zero in on your street to find your destination.
You got it. Now, if you're a long-term investor, think someone focused on holding investments for years, what kind of time frame should they be watching on their charts?
Yeah, what's a good starting point for those who aren't necessarily glued to the screen all day?
Well, according to our sources, a good approach is to focus on monthly, weekly, and daily charts. The monthly chart gives you that big picture, the long-term perspective. The weekly chart shows you how things are moving over the intermediate term.
And the daily chart then fills in those finer details within that weekly context. Okay, that makes sense. So you're not jumping from a 5-year chart straight to a 5-minute chart.
Exactly. There's a kind of guideline for choosing those subsequent shorter time frames. The rule of thumb, if you will, is to select a shorter time interval that's no more than 1/4 of the previous interval.
Okay, 1/4. Got it. So if you're looking at a monthly chart, moving to a weekly chart fits that rule.
Exactly. And then going from weekly to daily keeps that logical connection between the different time frames. This is actually illustrated with ABL, AAPL, in the Level I curriculum. They show how analysts use this step-down approach from monthly to weekly to daily.
Okay, so you're maintaining a consistent relationship between those time frames as you zoom in. Now, this isn't just for the long haul investors, right? I mean, short-term traders, especially day traders, they live and breathe these shorter time frames.
You're absolutely right. This multi-interval analysis, it applies to every style of trading and investing. The core idea remains the same. Analyze from longer to shorter intervals. It's just the specific durations of those intervals that change.
So a portfolio manager, let's say they adjust their holdings weekly, they might focus on daily charts for their most granular view.
Exactly. Those intraday swings are generally less important for their overall decision-making process. But for a day trader, well, that's a whole different ballgame.
Yeah, they're all about those rapid-fire movements. Hourly charts, 30-minute, even 1-minute charts become their bread and butter.
Precisely. For a day trader, those intraday charts are crucial for spotting short-term trends, potential support and resistance levels within the day, and those super precise entry and exit points.
I remember the source had this really interesting example, a trader needing to buy like a huge chunk of Pfizer PFE stock. I think it was 100,000 shares back on October 19th, 2020. The decision to buy was a given, but the question was when to pull the trigger for the best price.
Oh, I remember that one. That's a perfect illustration of how analyzing multiple data intervals can make all the difference. So the trader would likely start with a recent daily candlestick chart, kind of like what's shown in figure 3.1.1, covering the period from September 15th to October 16th, 2020.
Okay, so they're getting that initial overview, a sense of recent price action, right?
Right. This daily chart allows them to spot any trends that have developed, those key support levels where buying demand might be strong, and resistance levels where selling pressure could kick in.
And in this specific scenario, what kind of insights would that daily chart have offered?
Well, the description points out a pretty significant event on Friday, October 16th. There was this tall, bullish candlestick, meaning the close was way higher than the open, and it broke above a resistance zone around $37. And those short wicks, they suggest strong buying throughout the day and a real conviction to push that price up going into the close.
So the daily chart is signaling potential upward momentum, but it doesn't tell you when during that Friday the buying was strongest?
Exactly. And that's where zooming in to a shorter time frame becomes essential. So to really dissect the intraday dynamics of that breakout, the trader would then turn to an hourly candlestick chart, like the one in figure 3.1.2. This chart covers October 12th to 16th, 2020, but it breaks down each day into hourly segments.
Okay, much more granular. So what would this hourly chart reveal about the Pfizer stock on that Friday?
It would likely show a strong opening for Pfizer, followed by a general upward trend throughout the day. There might have been some consolidation periods, maybe a temporary stall in the price increase, but the overall direction is up. And this is important for our trader because they need to buy on the following Monday. Seeing that upward trend continue on the hourly chart, it gives them more confidence that the breakout was genuine.
They see that the move wasn't just a fluke, and it might even continue into the start of the next week, so buying sooner rather than later seems like the play.
Exactly. They want to get in before the price potentially climbs even higher.
And for a massive order like that, even a small price difference can make a huge difference in the total cost. I'm guessing they might even go down to even shorter intervals for actually executing that order?
Absolutely. For an order of 100,000 shares, every little price tick matters. So the trader might drill down to 10-minute or even 1-minute charts. They're looking for the most opportune entry point, signs of sustained buying interest to minimize what's called slippage.
Slippage, that's the difference between the expected price and the actual price you get filled at.
Exactly. And when you're dealing with a large order, minimizing slippage is crucial.
Okay, so it's a step-by-step process. You start broad, get that overall context, then you narrow your focus, getting more and more granular to really fine-tune your trading decisions. Now, are there any specific things to keep in mind, maybe some potential pitfalls when working with these super short intraday timeframes?
Oh, there are definitely a few things to consider. The volatility and the average daily volume of the stock you're trading, those are crucial. Highly volatile stocks, especially those with high trading volume, they generate more meaningful price action on the shorter time frames.
So if a stock's not moving much, zooming in really close isn't going to magically reveal a clear trend.
Nope, it'll probably just be filled with random noise. Another thing to think about is your access to high-speed data feeds. And just as important, how quickly your broker can execute your orders.
Right, because if there's a delay between seeing a price move and actually getting your order filled, that opportunity could vanish in a blink.
Exactly. And just to reiterate, for our long-term investors out there, all this intraday noise, it's usually just that noise.
Yeah.
It doesn't really affect their long-term investment thesis. They're looking at those broader trends, the fundamental value of the companies they're investing in.
They can ignore the short-term frenzy, but that principle of starting broad and narrowing your focus, respecting that one-quarter relationship between the intervals, it's a solid approach no matter what your trading style is.
I couldn't agree more.
Now, the source pointed out something I hadn't really thought about before. Hourly charts, specifically when we're looking at the U.S. stock market, there's a little quirk to be aware of. What's the deal with that?
Yeah. This is an important detail for anyone who regularly uses hourly charts for U.S. stocks. The standard trading day, it runs from 9:30 a.m. to 4 p.m. Eastern Time. That's 6.5 hours, or 390 minutes of trading. But here's the thing. Most charting platforms will display this as 7 distinct hourly bars or candlesticks.
7 hourly bars for 6.5 hours of trading. How does that add up?
So the first hourly bar usually represents the price action from the market open at 9:30 a.m. to 10:30 a.m. Then you get subsequent hourly bars for 10:30 to 11:30, 11:30 to 12:30, and so on, up to 2.30 to 3.30.
Okay, that's 6 hours accounted for. But what about that last hour and a half of trading?
That's where the seventh hourly bar comes in. It captures that final 30 minutes of trading from 3:30 p.m. to the 4 p.m. close.
Ah, so that last hourly bar on the chart, it's not actually a full 60 minutes of trading activity, it's just half an hour.
Exactly. And that can sometimes be misleading. You might look at that last bar and think it represents the same amount of trading activity as the other bars, but it doesn't. It only reflects half an hour of trading.
So, for anyone analyzing those intraday hourly charts, especially if you're comparing the activity in that last bar to the others, it's crucial to remember that it only covers half the time.
Absolutely. Otherwise, you might end up misinterpreting what the chart is telling you. Okay, so we've covered the ins and outs of working with multiple data intervals. Now let's switch gears and talk about charting multiple data sets. What's the purpose of putting more than one security on the same chart? What are we trying to uncover?
Yeah, what's the benefit of looking at multiple stocks side by side, so to speak?
It's all about analyzing relative performance and, just as important, the potential correlation between those different securities over the same period. Instead of just looking at one stock in isolation, you're comparing its movement to another.
Okay, so you're not just focused on whether a stock is going up or down, but how it's doing compared to something else.
Exactly. And the source uses a great example, figure 3.1.3. It shows a monthly line chart for Apple, AAPL, and Microsoft, MSFT, from November 2016 to July 2020.
So two big tech giants. What kind of information can we get from seeing their price history plotted together?
Well, first, you can visually assess which stock has had a stronger trend, whether it's up or down. You can see periods where one clearly outperformed the other, and you can also start to get a sense of whether their price movements tend to align, if they generally move in the same direction or not.
Which brings us to the concept of correlation, right?
Exactly. In this context, correlation means how much the prices of Apple and Microsoft tend to move together. If they generally both go up or down at the same time, they have a positive correlation.
They're kind of in sync with each other. Now, the source contrasts this with figure 3.1.4, which shows a monthly line chart for Apple, AAPL again, but this time paired with Boeing, BA, over the same time frame. What's
Yeah.
the difference here?
Oh, the difference is pretty striking. The Apple and Microsoft lines, they look somewhat similar, suggesting some degree of positive correlation. But the lines for Apple and Boeing, they look very different.
They're not moving in sync at all.
Not at all. You can see that in the early years, Boeing actually had a stronger uptrend than Apple. But then later on, their paths diverge. Apple kept climbing, while Boeing's price took a serious dip.
So it seems that when those lines on a multiple data set chart run parallel, that points to a high correlation like we saw with Apple and Microsoft. A steeper incline in one line tells you that stock had a period of relative strength.
Exactly. And when the lines go in opposite directions, that's a clear sign of low or even negative correlation.
They're doing their own thing.
Right. Now, the source also introduces scatter plots as another way to look at correlation. Figures 3.1.5 and 3.1.6, they show scatter plots for AAPL versus MSFT and AAPL versus Boeing.
Scatter plots, those are the ones with all the dots, right?
Exactly. Instead of plotting price against time, a scatter plot puts the price of one security on one axis, usually the vertical one, and the price of the other security on the horizontal axis. Each dot represents the combination of their prices at a specific point in time, which in this case is each month.
Okay, so each dot is like a snapshot of where those two stocks were at a particular month.
Precisely. And the key thing to remember is that the scatter plot itself doesn't show the chronological order of those snapshots. It's just showing the relationship between the prices. So if we look at the APL MSFT scatter plot, figure 3.1.5, what does that pattern of dots tell us about their correlation?
Well, I'm seeing that the dots seem to cluster together in a kind of upward sloping pattern.
Exactly. That clustering is a sign of positive correlation. When Apple's price was lower, Microsoft's tended to be lower too. And when Apple's price was higher, Microsoft's was generally higher as well.
You could almost draw a line right through the middle of those dots, and it would have a positive slope.
You got it. Now, compare that to the AEPL Boeing scatter plot, figure 3.1.6. It's a whole different story.
Yeah, the dots are all over the place. No clear pattern at all.
Exactly. It's much more dispersed. You see times when Apple was low and Boeing was low, but also times when Apple was low and Boeing was high, and vice versa. There's no discernible trend in those dots.
So that scattered, jumbled mess of dots, that's a visual representation of their low correlation. Their price movements haven't really been connected over that time period.
You nailed it. By charting multiple data sets, whether it's through those line charts or these scatter plots, analysts can gain a really valuable understanding of how different securities move in relation to each other. This can be super useful for things like portfolio diversification.
Diversification, that's where you try to hold assets that don't all move in the same direction, reducing your overall risk.
Exactly. And it's also important for something called relative value trading, where you're looking for mispricings between securities that historically have moved together.
Okay, so understanding these relationships can be pretty powerful for making informed investment decisions. All right, that brings us to the end of our exploration of multiple data sets and intervals. Now let's shift gears and dive into this intriguing technique, market profile.
This is where it gets really interesting. Market profile. It's a unique way of charting, developed by J. Peter Steidlmayer back in the mid-1980s at the Chicago Board of Trade, the CBOT.
The CBOT, the granddaddy of futures trading. What was so special about market profile that set it apart from traditional charting methods?
Well, the heart of market profile is this idea that the market's continuous option. It's constantly trying to find a balance between buyers and sellers, a price level where they agree. Stidlmayer called this the fair price.
So the market's like a giant tug of war between buyers and sellers, trying to settle on a price they can both live with.
That's a great analogy. And trading that happens around this fair price, well, that's just redistribution as participants trade at this agreed upon value. But when you get an imbalance, like more sellers than buyers or vice versa, that's when the price starts to move away from this equilibrium. Too many sellers drive the price down, and too many buyers push it up.
Supply and demand in action. So Steinemeyer was basically watching this whole auction process unfold and noticed something interesting.
Exactly. He observed that during a typical trading day, those prices tend to cluster, to concentrate around that perceived fair price. The prices at the extreme highs and lows, they're visited less frequently.
So the action is concentrated around that sweet spot, the fair price. But how did he create a visual representation of this clustering? How is a market profile chart actually built?
His method involved dividing the trading day into specific time periods, usually 30-minute blocks, and then meticulously recording how many of those periods a particular price level was traded at. This creates a distribution of price activity over time.
So you can see which price levels were the most active and which ones were basically ignored.
Exactly. And the interesting thing is, the visual output often ends up looking like a bell curve, but laid on its side.
A sideways bell curve. Interesting. What does that tell us about the market's behavior?
Well, that widest part of the bell, where you see the most price observations across all those different time periods, that represents the area of greatest agreement between buyers and sellers. It's the zone considered to be the value area, the range of fair prices.
So that's where the market spent most of its time, where most of the trading happened, and those narrower tails of the bell.
Those represent the price extremes. They were tested, but the trading activity wasn't sustained there. It's like the market was saying, nope, too high, or nope, too low.
The source gives this example of a UR/USD Forex trader watching a specific price range from 1.180 to 1.1800. How would they go about creating a market profile for this?
First, they'd set up their chart. On the vertical axis, they'd mark that price range from 1.180 to 1.1980. Then they'd divide the trading day into those 30-minute blocks, each with a unique label.
So let's say A for the first 30 minutes, B for the next 30, and so on.
Right. And as the trading unfolds, they simply note the price levels touched during each period. For example, if during period A, the EURUSD trades between, let's say, 1.1883 and 1.1897, they'd put an A next to each of those prices on their chart.
Like marking the territory, showing where the action happened, and they keep doing this for every 30-minute period.
Exactly. So as the day progresses, certain price levels will start accumulating more and more letters next to them.
They're getting hit again and again, showing that they were traded at multiple times throughout the day. What's the significance of those heavily traded price levels in the market profile framework?
Those are the key areas. They show where there was a lot of activity, a balance between supply and demand. The market spent a lot of time there, and that's why they're considered the fair prices, or the value area for that day.
Makes sense. So those levels are like magnets, drawing in the most trading activity. And what about those prices at the extremes, the ones that only have a few letters next to them?
Those are interesting. They suggest that the market tested those levels But buyers or sellers weren't really convinced. Like
Yeah.
maybe a high price of 1.1897 only has an A next to it. That could mean buyers pushed the price up there during that initial 30-minute period, but then backed off.
Not enough conviction to keep it up there. And on the low end, it would be the same, but with sellers initially driving the price down, but not finding enough buyers to keep it going.
Exactly. Now, remember we talked about the CBOT, the birthplace of market profile. Well, they had to adapt this technique for markets that trade 24 hours a day, like futures and Forex.
Yeah, those markets never sleep. How did they handle that extended trading day?
They simply extended the letter system. They use uppercase letters A through X for the first 24 half-hour periods, typically from midnight to noon. Then they switched to lowercase a through X for the next 24 periods, from noon to midnight.
So a full alphabet for a full day of trading. And are there any other variations or tweaks that people use for marking those time periods in a market profile?
Absolutely. While the traditional letter system is common, some analysts might use different colors or symbols to represent even shorter intervals within those 30-minute blocks, maybe 5 or 10-minute intervals, or to highlight specific events or trading patterns.
So there's some flexibility there,
Yeah.
but the core idea remains the same. Organize that price data by time and highlight those areas of agreement, those potential fair value zones.
Exactly. It's a really unique and insightful way to look at price action. You're not just seeing the price, you're seeing the story of how the market arrived at that price.
It's like reading the market's diary, seeing its thoughts and feelings throughout the trading day. All right, this has been a fantastic deep dive, really eye-opening stuff. For our listeners who are studying hard for that technical analysis exam, what would you say are the must-know takeaways from all of this?
For those exam preppers out there, focus on these key points. First, mastering multiple data intervals. You need to be comfortable moving from those long-term charts to those granular short-term charts and understanding the relationship between them. Remember that rule of thumb. The shorter interval should be no more than 1/4 of the previous one. And pay close attention to those intraday charts, especially how the trading day is divided into those hourly bars. Next, charting multiple data sets. You got to be able to visually compare the performance of different securities, see how they move together or diverge. Master both the line charts and those scatter plots. They each reveal different aspects of correlation. And finally, really grasp the essence of market profile. It's about organizing price data by time, highlighting those areas of high trading activity that represent the market's fair value.
Fantastic summary. Really drives home those core concepts. And for you, our listener, as you continue to explore the fascinating world of technical analysis, I want you to consider this. How can those trends you identify across multiple time frames work together with the fair value insights you get from market profile? Could aligning those two perspectives give you a more complete, a more powerful understanding of the market and potential opportunities?
That's the challenge, connecting those dots, combining those different analytical lenses to see the market with greater clarity.
It's like putting together a puzzle, each piece revealing a little bit more of the bigger picture.
And as you continue to learn and refine your skills, that picture becomes clearer and clearer.
And that, my friends, is the power of technical analysis. Well, folks, thanks for joining us on this incredible journey into the depths of charting. Keep those charts coming, keep those brains engaged, and we'll catch you on the next deep dive.
Until next time.